I'll tell you this as a story because that's how it actually felt. Living it, I didn't wake up one day with a neat spreadsheet and a master plan saying Tesla will be profitable here and scale there. It was more like standing at the edge of a cliff with physics in one hand and cash burn in the other, and deciding to jump anyway because from the beginning, Tesla's financial performance was never about quarter-to-quarter optics. It was about survival first, then inevitability, then acceleration. And if you look at the early years, the numbers look insane. Massive losses, tiny revenue, skeptics everywhere. People saying the margins would never work, that batteries were too expensive, that no one would pay a premium for electric cars. But what they missed was that we were building the machine that builds the machine. The factories, the supply chain, the software, the battery tech, and all of that hits the income statement before it ever shows up as profit. So yeah, we burned cash like crazy, especially with the Roadster and Model S days, because every dollar went back into engineering, tooling, and vertical integration. And when Model S launched and started generating real revenue, it wasn't just a car, it was proof that gross margins on EVs could beat internal combustion if you design everything from first principles. And that's when you start seeing automotive gross margins climbing, not perfectly, not smoothly, but trending upward as volumes increased. And then came Model 3, which from a financial perspective was the hardest thing we ever did. Production hell was real, capital expenditures were brutal, and the balance sheet was under constant pressure. But the bet was that high volume manufacturing would unlock operating leverage. And once we crossed that threshold, the numbers started telling a different story. Revenue scaling exponentially year over year, fixed costs getting absorbed. And suddenly Tesla wasn't just a car company bleeding cash. It was generating operating profit, free cash flow, and building a war chest. And people forget how important that moment was when Tesla posted sustained profitability, because it flipped the narrative. We didn't need to raise capital just to survive anymore. We could fund growth internally. And that's when financial performance becomes a flywheel, because higher margins fund more factories drive higher volume drives lower unit costs, and lower unit costs protect margins even when prices drop. And you saw that play out as we expanded globally. Shanghai was a massive inflection point financially, capital efficient, fast to build, strong local supply chain, and suddenly our return on invested capital improved dramatically, which is something traditional automakers struggle with. And then Berlin and Texas followed, each one designed to push costs down further through structural battery packs, gigacasting, simplified wiring, all of which shows up directly in cost of goods sold. And when people look at Tesla's financials and focus only on revenue growth, they miss the deeper story, which is that we're constantly trading short-term margin for long-term dominance, cutting prices strategically to expand total addressable market while still protecting positive operating income. And that's a very delicate balance, because Wall Street likes predictability, but real-world manufacturing likes scale. And then there's energy generation and storage, which for a long time looked small on the income statement but had massive potential. And now you're seeing margins there improve as Megapack scales, on turning what was once a side project into a meaningful contributor to gross profit. And then there's software, which is where the financial model really bends, because once you've built the fleet, software revenue, like full self-driving, carries extremely high gross margins. And even deferred revenue becomes an asset because it represents future recognized profit with minimal incremental cost. And all of this feeds into cash flow, which is the ultimate truth teller, because you can argue about EBITDA all day, but free cash flow tells you whether the company can breathe, and Tesla's ability to generate cash while still investing billions in R&D and CapEx is what makes the whole thing durable. And yes, margins fluctuate, macro matters, interest rates matter, commodity prices matter. But structurally, the company is far stronger than it was a decade ago, with a balance sheet that has more flexibility, lower debt relative to scale, and the ability to weather downturns while competitors struggle. And when I look at Tesla's financial performance, I don't see a static picture. I see a vector, a direction, where short-term volatility is noise and long-term value creation is the signal, because the mission was never to maximize profit in a single year. It was to accelerate sustainable energy. And paradoxically, the more aggressively you pursue that mission, the stronger the financials become over time, because you're solving real problems at scale. And that's the part people underestimate. That doing the hard thing, the expensive thing, the thing that looks financially irresponsible at first, is often the only way to build a company whose financial performance compounds instead of decays. And that's Tesla's story. Messy, stressful, sometimes terrifying, but ultimately grounded in the idea that if you get the physics and the manufacturing right, the financials will follow. Because once Tesla showed consistent profitability, the challenge wasn't survival anymore, it was discipline. And that's actually harder, because when the company starts generating billions in revenue and cash flow, there's a temptation to optimize for comfort or optics. But comfort kills innovation, and financially we kept pushing the system to its limits, reinvesting aggressively even when analysts wanted us to just sit back and harvest margins. Because the real financial risk is stagnation, not spending. And you can see that in how Tesla uses capital. We don't just build factories, we redesign them, we collapse steps, we remove parts, we question every assumption that drives cost, and that mindset directly shows up in operating expenses as a percentage of revenue staying relatively low compared to legacy automakers. Even as revenue scales, because efficiency isn't just engineering, it's financial philosophy. And then there's pricing strategy, which people often misunderstand. When we cut prices, it's not because demand disappears overnight. It's because manufacturing cost curves are coming down, and we want volume to move faster than competitors can react. And financially, that looks scary in the short term because margins compress. But strategically, it expands the installed base, and the installed base is where long-term value lives, because every car on the road is a platform for future software revenue, service revenue, energy integration, and data-driven improvement. And that's why Tesla's financial performance can't be analyzed like a normal automaker, because a traditional automaker sells a car once and hopes to make money on financing and service, while Tesla treats the car as a continuously improving asset, which changes the lifetime value calculation entirely. And when you look at deferred revenue from software features like full self-driving, that's basically profit waiting to be recognized. And that's a very unusual thing in the auto industry. And then you add energy storage scaling up, which benefits from many of the same battery and manufacturing learnings. So R&D dollars get leveraged across multiple business lines, improving overall return on investment. And that's when the financial model starts to resemble something closer to a tech manufacturing hybrid than a car company. And markets struggle with that because they like clean categories. But reality doesn't care about categories, it cares about efficiency and scale. And through all of this, Tesla's balance sheet becomes a strategic weapon because having strong liquidity means you can act when others can't, build when others pause, lower prices when others are locked into high-cost structures, and financially that's asymmetric warfare. And yes, there are quarters where margins dip, where revenue growth slows, where headlines turn negative, but internally, the metrics that matter are production cost per unit, cash flow resilience, and the speed at which innovation translates into cost reduction. And as long as those vectors point in the right direction, the long-term financial performance remains intact. And people often ask whether Tesla is done investing, whether the heavy spending years are over. And the honest answer is no. Because as long as there are inefficiencies in transportation and energy, there's room to deploy capital at high returns, whether that's autonomy, robotics, grid-scale storage, or AI infrastructure. And each of those has the potential to reshape the income statement the same way Model 3 and Model Y did, slowly at first, then suddenly. And that's why Tesla's financial story isn't about peak margins or peak valuation. It's about compounding advantage, where every year the company gets better at turning raw materials into value. And that's the part that gives me confidence. Because when a company learns faster than its competitors and allocates capital with that learning in mind, the financial performance becomes less about luck and more about inevitability. And that's where Tesla is now, not finished, not stable, but fundamentally positioned so that even the hardest problems, the ones that cost the most money up front, are also the ones that generate the strongest financial outcomes over time.